Welcome to Private Banking Strategies Podcast with Vance, Lowe, and Seth Hicks, your secret weapon to protect your assets and never have to start over financially again. Vance and Seth help high net worth individuals, families, business owners, and investors structure an asset-protected, tax-free fortress for their families. Learn how to keep what you earn and use the velocity of money to create your own private banking system. Join us on this journey as we explore the secret strategies of the rich and political elite and help you take total control of your financial security. Now, on to the show.
Welcome to Private Banking Strategies Podcast with Vance Lowe and Seth Hicks. Vance, how are you?
I'm doing great. How are you?
Doing well. Yeah, I'm excited about our topic today. We're going to discuss business-owned insurance policies on employees and some of the values that those bring to businesses and how to use those. So I'm super excited about that. A lot of our clients are entrepreneurs and business owners and like to structure this within their businesses.
Yeah, I think that the business side of private banking strategies, there's so much wider opportunity to use this strategy in. And as business owners start learning the concept of money, how to control it and how to get it back, they can find all kinds of ways within their business to be able to use that strategy and be more profitable and more beneficial to the employees, everybody involved.
And we've also talked about business cash flow as a way to catapult personal wealth within a business. And we've talked about that in relationship to Nelson Nash's nephew, who ran a forestry business. And we did a multi-part series called Paul Bunyan and how to use your business to effectively create wealth with just the cash flow that's coming into the business. And so folks, get your pen and your pad and take some notes and jot that down, the Paul Bunyan series, because that dovetails into this employer-owned policies really well when you want to structure a business that's meant to last for legacy. So Vance, what are some of the fundamentals of the employer-owned policies?
Well, one of the facets of many is employee retention. You can kind of go in partnership with an employee and use what's called golden handcuffs to incentivize the employee to stay with your firm. You've been there a long time. You've probably invested a lot of time and actual money in helping the employee be more productive for the company. And the last thing, it seems like every time in business we train somebody and we get them to a really productive level, they get stolen away by someone.
Right. There's not a loyalty-based culture like there used to be when, our parents and our grandparents ran businesses or worked for people. There was a sense of loyalty. And so now you have to create constructs that incentivize people to stay. And these tools are used by some of the big boys in the industries like banking. Wells Fargo, Bank of America, they have these employer-owned policies on everyone down to the bank teller.
Yes, one of the incentives to keep key bank employees are totally involved in this type of strategy, mainly for the branch presidents and vice presidents. When an employee gets to that point, they become very valuable to the business, the banking world, and so they incentivize them to stay. I don't know about all the listeners out there, but my banking experiences, I've always tried to establish a banking relationship with someone who's over my accounts, and it seems like they change 2 or 3 times a year. And because they keep moving on, and even the branch president sometimes will move on. Seth, let's kind of outline what that incentive is for us or for the bank to keep those big employees.
The way that it typically works is a life insurance policy is taken out by the company on the life of an employee or group of employees, and that policy accumulates cash value. The company pays the premiums, and the company is the beneficiary if the employee dies. Now, what benefit does the company give to the employee? Let's say that it's a bank teller. Let's start at the bottom and work our way up, Vance. So, if you've got a bank teller and you want to create a package for lower tiered employees, you could do that by providing a death benefit for no cost to them. They don't pay the premiums. They don't have any obligation on the maintenance of that policy, but the company pays the premiums. And let's say that that employee is insured with a $250,000 death benefit. They can provide a portion of that death benefit to the employee's family while they're employed there. So Wells Fargo and Bank of America, for example, will provide a $25,000 death benefit to their bank teller while they're working there in the event that they happen to pass, so that their family has funeral expenses and some other costs covered. That's kind of the lower level aspect of it. And as you work your way up in higher management, mid management, CEOs, those incentives become much, much greater. So, like, for example, if you got a 10-year loyalty bonus, they could be paid $100,000 out of their cash value that's accumulated, or even higher. So that's kind of a 30,000-foot overview. What would you add to that?
Well, yeah, let's kind of talk about the top a little bit, and then we can talk about the volume of money that banks actually put in this. Banks have never lost the strategy. They understand the strategy better than anyone out there, and they use it to their advantage. So with the higher echelon people, they pay a premium for each account of at least $25,000 in these banking contracts. Again, they're reverse engineered for a little bit lower death benefits, but if you take an employee from a teller all the way through their career at age 65, that's an awful long time. And they give them the incentive for one, if you make it to retirement under our plan, we're going to bonus you out. And the programs that I last heard was about $700,000. They would actually borrow the money from the policy and pay them the bonus of $700,000. They would get to deduct that money from, expenses, because the client would receive that, or the employee, retiring person, would receive that as ordinary income. And then they would have a hole in the policy of $700,000 that they could dump in,
Right.
additional cash. And that's what they use it for, is they call it A level or A tier lending. This level of lending is not even audited. It's so pure that they can use that money, borrow money from all of these contracts, and use them however they need to, which creates more holes, which they can fill back up. At the end, it's almost like the banks are in the life insurance business, because when a retiree takes the bonus, they do not give him the contract. He's now out of that contract, unless they've made arrangements to continue to pay a death benefit of X amount. That could happen. But normally, even if that's the case, when the individual dies, there is usually somewhere between $1.5 and $3 million death benefit, because it's built up so high, and that belongs to the bank. If the bank didn't take any deductions for the premiums, which they don't, then they receive that, or a product of the bank, a trust of the bank is the beneficiary. It's not the bank themselves. I think it's more of an ancillary company receives the death benefit income tax free. So think of the possibilities. If they're putting in $25,000 for every one of these things, Seth, what do you think the premium for a bank is on those types of things?
Well, I think the last time I checked the statistic, it was about 20 billion annually that Wells Fargo put into life insurance premiums on employees. 20 billion.
Yeah, that's a huge number. So You're also discovering that banks are probably one of the number one clients of the life insurance carriers. They pay
Absolutely.
a tremendous amount of premium. And so they kind of protect this. So again, we say, this strategy and storing your money is probably the safest place on the planet to be able to do those types of things. So we're just barely, we can explore quite a few other options.
Yeah,
Go
let's
ahead.
talk about, for example, how can a business take a policy on an employee? Usually, you would, in a family context, you can take a policy out on the patriarch or the matriarch or a breadwinner and to replace their income from a death benefit perspective. But how does a business take out a policy on an employee? Do they have a right to do that?
Yeah, and a lot of employers, that's one of the main questions they have, or one of the first questions they have. You have a vested interest in that employee. You are paying for his education or her education in their expertise with your company. And should you lose that employee, you're going to suffer, the business is going to suffer a financial loss. And everybody knows when there is a financial loss, that would fall under the term of key man, employees, and be a liability to the company if they don't insure that. So they can either take that loss, retrain a new person, they're going to have to anyway, but are they going to have to suffer the expense all over again? If they purchase a life insurance on that person, then they've got the funds to train the new person without going in the hole all over again.
Right. So they have what's known as an insurable interest on their employee that gives them the ability to create that life insurance contract and be made whole in the event of a loss.
Yeah, it's very rare if you approach an employee and offer to put life insurance on that person, offer a death benefit, and the employer pay all the expenses of that policy. It's very rare for an employee to reject that. The only time we would have a problem if for some reason that employee was uninsurable. And that needs to be known because many employers don't know the actual health of their employees, especially a lot of their key people. Now, when you get into big corporate, they a lot of times will send their key executives to get health exams and everything else, whatever they need, so that they can monitor the health of a key person if that person's very valuable. The younger other ones, it'll filter out. They'll come back with information, or you can get information as to whether it's a preferred rating or if it's rated, why is it rated? And that also helps the employer plan for the future.
Yeah, I mean, there's so much turnover in businesses, and the retention is a valuable aspect of profitability for businesses. And so when you have these turnovers, every couple of years or 3 years or even less, like you described in your some of these other banking relationships, you see people turning over all the time. It's a great cost to the business. And I think with even smaller businesses and entrepreneurs that are closely held, and have a smaller number of employees, the significance is even greater. You've got to take that into consideration so you don't get, have a flat tire and not able to move your business forward. Here's another question that I wanted to ask you, Vance. And we'll go ahead and comment on that, and then I'll hold my question for a second.
Well, I just have a thought. I thought I'd throw it in before I forget it. We probably ought to throw in here the economics. What is the cost to the employer to run one of these things? And what we try to do is we try to build very, very efficient contracts to get to 100% efficiency as quick as possible. Now, it's a startup. Every one of these contracts are a startup, and they need time to generate, just like a new company does. A new company can't expect a profit, for 3 to 7 years. The average is 5 years. Well, in this case, we have access to funds immediately when we pay the first annual premiums. And employers should think about everything's normally done on a monthly basis, but this is something you want to do annually. If we do it annually, they pay upfront all the earnings and the profits. It's called annualization. America used to be under before banks took control, but life insurance company has stayed that way. So when you make an annual payment, you get the guaranteed buildup in cash value. You get access to that within the first week, 2 weeks. And, that averages, 50 to 60% of what the premium. The next year we pay that premium, it's 75%, 85%, then 90%. And the fourth year, somewhere around 90 to 100%. And then things change and we can get over 100% for premium paid starting year 5. The policies change up a little bit and we go through that. It's kind of technical issues. We don't need to go through that today. And we've done this in other podcasts, completely dissected how we set these contracts up. But the employer, the economics is there's money available to be used from these contracts owned by the employer. They own the rights to that cash value and they can borrow that and put it back at will.
Did that story feel like it was about you? Do you feel like you are generating a lot of revenue but are not moving forward as fast as you would like? Do you feel you should be making more progress toward your financial goals? Do you feel stuck? Let us help you get unstuck. Are you ready to take action and get your own private bank? Please visit us at www.privatebankingstrategies.com.
Let's give an example based on the hypothetical, and I quoted a number, 20 billion, that I think Wells Fargo is paying in annual premiums on life insurance policies. And after these policies are in effect for a number of years, and starting in years 5, 6, and 7, you put in $1 of premium and you actually get $1.10, $1.20, $1.30 in cash value available to use in the policy. Is that correct?
Yeah. So a typical example, if you put $10,000 in premium in year 5 or later, you're going to see that the cash value growth is 12,000 or maybe even 13,000. Right. You only put 10 in, but to go back and be, as a disclaimer or fair practice, there's a lot in play there to make that happen. But all we care about on the economic side is if I'm paying a premium in, am I making money or is it costing me money? In year 5, and at least maybe even in year 4, you're making money by paying the premium. And this is money that can be used. It can be borrowed. It can be surrendered. Any number of issues. You just want a little consultation. Do it the right way.
And in the context that I described for like Wells Fargo, if they're at an efficiency level with a seasoned policy on all 20 billion and they're making $1.20 on that 20 billion, they just made $4 billion.
Yeah.
That's 20% on their 20 billion, $4 billion in available cash to utilize in their business. So it goes parabolic pretty fast as the efficiency increases year over year. And that's why it's so valuable. Now, I was going to ask you a question. What about closely held businesses where there's 2 or 3 key people in an LLC or a partnership? How do those work? Can you take, reciprocal policies on each other? And then I'd also, as a follow-up, you can describe a gentleman that you'd worked with previously that had, I think, over 100 contracts from business relationships. None of them were family or him because he was maxed out on what his insurability was. And he created businesses to effectively do banking.
Right. The business world is the opportunity to use money the way it's intended. And closely held companies, like you mentioned earlier, you can take policies out on each other. So if you've got 3, what is that? That's a combination of 6 policies. because all three of you are taking policies out on two of the other partners, and that's a total of three. And that's where you store your money. If someone is really smart, they understand that if I put my premium in the policies, I'm going to get equal to or greater than market rate returns tax advantaged. And it's yield. It's not average rate of return, which is a fictitious number according to the actual product. It's just a mathematical number where yield is money put in the account that cannot be reversed. So putting your money there is your bank. It is a way for you to access the money, borrow it, pay yourself back with interest, grow it, and be totally tax advantaged and have those types of transactions. They're private. They're not taxable events at all, be it business or be it personal.
So in that, the gentleman that I'd mentioned, it was always fascinating to me to understand how he would create businesses and business partnerships just for the banking aspect. And then effectively the business wasn't carried forth very far.
You have to really understand life insurance contract law and what has to be in effect at the time of issue. Everything is termed around issue when everything comes into play and is created. That's when all legal ramifications of life insurance have to exist. If there's any fraudulent or misrepresentation, then the insurance carrier has the opportunity to look and make adjustments, correct, or even rescind a contract over the first 2-year period of time. If it's outright fraud, then there is no time limit. So we don't even go into that area. We don't even get into any gray areas. But it's very, very much legal for 2 or 3 people to form a liability company or an LLC and function as an LLC, set up a checking account in that LLC's name and conduct a little business so that each other can purchase additional contracts of this nature. This is where we want to put money, and this is where we can really grow a lot of money. We do everything we possibly can. And so this LLC buys Keyman Insurance. So the guy we're talking about was one of my early mentors, and he would form these 3-man LLCs and literally write 6 policies under that LLC. And once everything is issued, there's no law saying that that LLC has to stay functioning and in existence. So that slowly dissolves anytime after those contracts have been placed and everything's fine. So actually, when I lost count, Seth, he was at 153 policies, and this was almost 20 years ago.
Wow.
And he personally was uninsurable.
There are clear ways to create your banking system without personal insurability, which is
Yes. So we just need to talk and brainstorm on how we get insurability on someone. Every criteria has to be met in
right.
order to get a policy, but everything has to exist on the day of issue. After that, there's no rule.
Well, we've talked mostly on the benefits and values to the business owner, the employer. Let's focus for a second on the benefits to the employee. And this is something that bears flushing out so that our business owners out there and folks who have people that they can create a business insurable interest on understand. One is that for lower level employees, like we talked about, let's call it a bank teller or the blue collar people in a roofing business, it's an affordable way for them to access the basic life insurance coverage that they may not otherwise have or pay for. And they don't pay for it. They don't have to come out of pocket a single dollar to have that protection for their family. That's a great benefit for lower tiered employees. I think that creates security for their family members, their wives, their children, and they don't have to work any harder, for that. What else do you find as a benefit for the employees?
Well, the employer can be very conscious of the employee's needs sometimes. Every once in a while, a financial crunch happens to the employee, or he's thinking about moving on or leaving. You catch word that, maybe he's not as happy. And you had mentioned earlier that there are year marks where if an employee makes it to year 5, for instance, he gets a bonus. And that bonus can be predicated on a annual review and commitment that they're going to stay with the company. It can be tied to that. The employer can create a contract where he can dump a bunch of money in there. He could provide a death benefit for, the family that isn't paid for by the employee. Now the employee feels a little more secure a lot of times that if something does happen to me, at least my family will be taken care of a little bit. And that can increase over time, that death benefit, as well as little bonus incentives, and all the way to retirement. If you stay here until retirement, we will bonus you X amount. That ties that client or that employee to the business. An employee will change for $1 an hour, maybe even less, maybe even a 50-cent per hour raise. Oh, you're getting paid that? Well, we'll offer this. And they're gone. That's the loyalty out there. So employers, if they're smart, will think up incentives to keep the employee at home, working where he's at, and offer that employee a way to grow with the company. If a teller is a teller and they don't ever see an opportunity to not be a teller, they're gone at the very next offer, because the next offer, that person probably said, oh, you've been a teller for a long time. We'll come in, we'll start you here, but we're going to move you to an executive position.
You touched on one huge aspect, which is the ability for the employee to access loans without rigorous financial qualification. So if they want to finance aspects of their personal life or through their employer-owned life insurance policy, the employers can create ways to do that and deduct it from paychecks and be able to have secured collateral on that loan, and makes it very convenient for the employees and a benefit for working with the employer. That's a great one.
The old banking system needs to come back in. This makes us private. It makes us more independent. We create less taxable events. So the employer world needs to catch hold that this is a way to grow our business, make our business more productive, more profitable by keeping good employees longer. And you can't treat a good employee badly or they're going to be gone. This is one way to do it. And the sky's the limit on how you tailor it. We could talk, like I said, you and I could probably do podcasts for hours just on the possibilities of what they can do here. So I think anybody has an interest here, you owe yourself and your own company and your future to look into it a little bit more and see if this is right for you.
Absolutely. And so, folks, if you want to learn more about this, you can find all sorts of resources on our website. It's privatebankingstrategies.com. That's privatebankingstrategies.com. And if this is your first time to hear our podcast, you'll have an offer for a book that Vance and I authored called Secrets That Banks Don't Want You to Know, that effectively keep you from being wealthy and financially free. And after that book offer is offered to you, you can listen to that in audio or PDF for just putting in your name and your email. And we also have, I think, closing in on 100 podcasts now where you can listen to all sorts of various topics and educate yourself on these issues. And if those things are resonating with you, our book resonates with you, these topics resonate with you, then schedule an exploratory call with Vance, which is in the email that we will send once you provide your email to us. So there's an exploratory call link in Vance's emails where you can actually look into how these structures will apply to you personally, to your business in an employer-owned policy situation, and how you can make it work for you and your family. So we look forward to that, folks. We're glad you joined us, and we look forward to having you again on our podcast. Thanks, Vance.
Thank you, Seth.
Did that story feel like it was about you? Do you feel you should be making more progress toward your financial goals? Do you feel stuck? Let us help you get unstuck. Are you ready to take action and get your own private bank? Please visit us at www.privatebankingstrategies.com.
Thank you for listening to the Private Banking Strategies Podcast. Click the subscribe button below to be notified when new episodes become available.